Richard, thank you very much for doing this. This is a great pleasure for us. I want to talk to you about a handful of things, and I'd really like to start just with a bit of history. You had a front row seat when the financial crisis exploded. And I want to ask you about the art of crisis management as you saw it. I'm just talking about the way that the American government intervened in the banking system to keep it from really deteriorating to God knows what. How do you think about that episode in terms? How do you rate it, and what do you think the key lessons are that would put us in better stead the next time a crisis comes?
Well, Jeff, remember, I have a different background than many of my colleagues, so I hope viewers of this discussion or listeners of this discussion understand that I come from a business and an MBA type background rather than a theoretical background in economics. There's so many more people that are better equipped on that front than I am. So I tend to look at things from a managerial standpoint. Okay. And my answer to your question will be conditioned by that background, just to be open about this.
Okay, and one other thing by opening comment, I realize that you are speaking for yourself and not for the Fed. Okay.
Of course. So, first of all, I think one of the lessons learned and one of the things that impacted the way we tried to deal with this issue, and I think we managed to do it successfully, but there are so many moving parts, which I'll talk about in a minute, is that there had been a hands-off approach to regulation. Under Alan Greenspan, there was more of a laissez-faire approach. There also was widespread acceptance, I think, in the theoretical world that efficient market theory obtained. I always like to think of Fisher Black's great comment that markets look much more efficient on the banks of the Charles than they do on the banks of the Hudson. And so, if you followed that school and you followed what I still consider a very great man, Al Greenspan's firm belief that markets would self-correct, they might overshoot a little bit, but they had the capacity to do that. I think that was a misconception, and we learned that. We could see things becoming disjointed. You saw it in the mortgage-backed business, the kind of people that were conducting that business, the way things were being packaged and sold and lost track of. You could see it somewhat priced into the markets in terms of the CDS spreads, credit default swap spreads that were being imputed and priced for certain institutions. But what concerned me from my perspective, given my background, is that we were reactive rather than proactive and had to cobble things together almost suddenly. Now, we had a leader who had to learn a great deal. This wonderful man, Ben Bernanke, in the case of the Central Bank of the United States, the Federal Reserve, was put in the chair just as the peanut butter hit the fan. And, very sophisticated financial instruments were the cause of this risk. I don't think there was anything truly unusual from a historic standpoint because, as Charles Mackay wrote in that extraordinary work that he wrote in 1841, Popular Delusions and Extraordinary Madness of Crowds, markets not only overshoot, but they move in herds. And I recommend that as the primer, the primer, for anybody that wants to understand financial crises. Things really haven't changed. And they're given to excess. Well, we had a period of great moderation, as it was called. We were given to excess. I don't think we monitored it very well. Things that were outside of the central bank's control were very poorly monitored by the SEC. Lehman, for example, Bear. And then as a central bank, we have to come in and as the lender of last resort, the classic function of a central bank, basically open the sluice gates. But we had to learn on the run. So one of my criticisms during the process, and one of the things I kept drilling in on during the constant open market committee meetings and discussions we were having through televised means or teleconferencing or when we were actually at the table was, what's the decision tree? In other words, as we make a decision on X, what if Y obtains or Z obtains or A obtains, and then if that obtains, what do we do next? Being in a reactive mode, you really didn't have time to think that way. It's the way if you were putting people through the Yale School of Management or the Stanford Business School or whatever it may be. Notice I deliberately did not mention Harvard in this case. You're trained to think of, at least as a manager, you're making decisions under conditions of uncertainty. That's what business and finance and management's all about. But you try to at least limit or expand your understanding of what the outcomes might be, and then limit the damage that could be done. We didn't approach it that way. We didn't have time to do it. There was a severe reaction. It came about by ordinary human behavior, the driving force of greed and the desire for gain in a laissez-faire regulatory environment, at least as far as depository institutions are concerned. And it sort of just struck. We could see it coming, again, with the CDS spreads and so on, but in a relatively short period. And you could sense, as a market operator, which I used to be as a funds manager, you could sense the excess, but then the question is, what does monetary policy have to do with it? Well, the answer is macro-prudential supervision, as it's now called. The regulatory side of the franchise needed to be better equipped, and it wasn't. So being caught by surprise, it's something that's so deep and so serious, and not realizing the depth and severity of it all, I think was a great eye-opener and quite frightening. I do think that the way the Fed reacted and the way Ben Bernanke personally, watching the transformation of that individual from being someone who had an enormous intellect and great deep understanding of theory to come to grips with the workings of markets that he just wasn't familiar with was really a remarkable thing to watch. I mean, he's an extraordinarily gifted man. And little concepts, Jeff, like what's a repo? What's a reverse repo? How do derivatives actually work? And the complexities of the mathematics and so on. And then the pervasiveness of this issue to have a group of people that are largely driven by theory, don't have real financial market experience, have to have it interpreted by somebody who does, and then make very tough decisions on which there was very little room for error. It was a hair-raising experience. I had dark hair and dark eyebrows before that started.
well, let me ask you this. I mean, you paint a picture, and I know, you know, it's sort of you're talking shorthand.
Right.
That both the Fed and the Treasury under Paulson, they did the very best they could with the tools that they had and with the knowledge that they had at the time. It was very chaotic, and it was really sort of case by case without a real strategy. But what makes you think that, having gone through that, if there were another really major crisis, which I'm going to come to later, that the lesson of a more strategic approach will have been learned, or do you feel that it's kind of baked into the cake that a financial crisis is always handled in chaotic situations with sort of chaotic means? What is your view about the?
Well, no policymaker, Jeff, wants to admit that it's baked into the cake, but I mean, you and I could go back and discuss from the Mississippi bubble onward.
Right.
There are repetitive cycles throughout history, and you can go even further back than that to ancient Rome or the ancient Lydians. So, but you don't want to admit that as a policymaker, and you try to eliminate the risk as you go through time. I do think that obviously significant steps have been taken. We just completed, for example, the stress tests of some of the larger institutions. We are working internationally, all the central banks, and with through the Basel process, as well as through the laws that have been passed since this crisis occurred, mainly Dodd-Frank, to try to be able to detect and catch where the risks might be. But I'm hesitant to hold out false hope that we can somehow bend human behavior and make sure it never happens again. So the honest answer to your question is, I don't believe we can prevent things from happening again, but we should be aware of how they're developing and where the risks are, and the new products that are being created. The human mind and the pursuit of profit is always going to lead to enormous innovation. That's one of the great things about market capitalism, but you also build in risks, and sometimes to correct for the excess taking of that risk, you're going to have crises. I don't think, parenthetically, the legislation that was created, Dodd-Frank, and we can talk about that a little bit later,
Yeah.
solves the problem. But here's the point: there's so many moving parts in our government. You mentioned the Secretary of the Treasury, and of course the Chairman of the Fed, and all the other players that were involved. Coordinating that was not the easiest thing. Obviously, everybody wanted to, once they realized how serious this problem was. But they have different franchises, and we are the most independent of those franchises. You and I both have worked with the Treasury Department, and we know that in the end it's a political instrument of an administration. They try to be as unbiased as possible, but a president appoints a Secretary of the Treasury, and the Secretary of the Treasury is going to do anything they can to prevent their leader during their administration from not doing things well. In other words, to prevent them from doing things poorly. Right. So it therefore takes longer to pull everything together. Now there are institutional structures, for example, to identify and then oversee systemically important financial institutions, SIFIs as they're called. I like to say that sounds like a disease you might catch in a bar from bad behavior, but anyway. But, you know, it takes time. And time is always your enemy in a crisis, which is why you have to anticipate as much as possible and be aware of the financial instabilities that may be building or the excess risks that may be taking. We now have institutionalized at the Fed. We have reports. We really sort of sub rosa have made it part of our mandate to maintain financial stability, systemic stability. Right. But again, easier said than done, and the proof will be in the pudding as to how long we can then have stability before another one of these human-induced crises occurs, which I'm sure it will, hopefully not again in my lifetime.
So we're talking about the crisis period. I want to go to the post-crisis period and ask you a little bit about monetary policy. I think that right. You have said publicly that while you fully understood the need for quantitative easing, there were at least times when you felt the extent of it might have been too much. So what I want to really ask you is not so much about what happened, but where you think we are now and what you think the challenge is, not just for the U.S., but for the global financial system over these next several years as some of this stimulus is reined in.
Well, again, there are several parts to this equation. Right. What the central banks worldwide have done is they have flooded the markets with liquidity and suppressed interest rates all the way out the yield curve. At least we have, certainly. Right. So the one thing central banks can do, we can do at the Fed, is expand the monetary base. The monetary base now is massive. And the excess reserves that depository institutions have, and that's where we have our responsibility, and then above and beyond depository institutions, other economic players are massive worldwide. I'll give you a number that puts this in perspective. If we had not had the Great Recession, the economy today in the United States would be roughly $20 to $21 trillion in size of annual output. It was at 14, and we are now at 17 plus. So we lost space. But the monetary base is 60 times larger than it was before. Wow. Excuse me, I don't mean the monetary base, the total reserves of depository institutions. So the total reserves of depository institutions, whether they are kept in the vaults of the banks, the depository institutions, or kept in the vaults, as it were, of the 12 Federal Reserve banks in terms of required reserves and excess reserves, is now 60-fold what it was before the crisis. What that means is that there's a lot of dry powder in there that's waiting to be used and lent back into the economy. Well, there's a risk involved in there because what we now have to manage when we buy bonds, we've been buying, as you know, under QE3. We've expanded our balance sheet dramatically. We pay for something when we buy it. That puts money out in the system. It then now is being turned back and put back in terms of the reserves at the Federal Reserve banks and or held elsewhere. So we have this huge monetary base. It's waiting to be activated. And the real issue will be once the gears begin to click, and they're beginning to click, but it's not at a robust rate. The economy's growing. Banks start lending. People start using money, putting it to work in the economy. What economists call the velocity picks up. We're going to have to figure out how to control that so that we don't create inflation, which no central banker is willing to tolerate, just as we fought off deflation on the downside. So I think that's one challenging policy issue, but the basic problem is, just as with ordinary mortal singular human beings, any man or woman, money burns a hole in your pocket. So what we're seeing right now with high octane fuel basically is cheaply priced money, which costs nothing and is everywhere worldwide, is some pretty interesting risk taking. My favorite example is to look at the spread between junk credits, triple C rated credits. If you're rated a triple C, that means your prospect for success and ongoing operations are questionable. That spread over investment grade credits is enormously narrow, tiny, 270 basis points or so. And that's on top of historically low nominal yields for investment grade credits. So that's a little yellow light for me. You're also seeing historically high levels of margin debt. You're seeing lending taking place with very poor covenants on very generous terms at cheap prices. So again, risk is being taken here, and the question is, when does that get out of hand, and what crises might that create, and then how might we react to that? So, there's a little yin and yang here. You flood the markets with liquidity to prevent the system from collapsing. And my objection to QE3 was I didn't think we needed to go those final steps. I did support the first tranche, particularly mortgage-backed securities. We needed to turn the housing market. That's happened in spades. In terms of the Treasury market, and we've been buying on a ratio of 9 to 6, by the way. For example, the Dallas Fed, my little bank, which is a $157 billion bank, I have a little over a year-end, a little over $91 billion in Treasuries and 63 billion or so, maybe 60 billion in mortgage-backed securities. So a ratio of 9 to 6. And if you take that and multiply it through the system, the numbers are quite huge. And yet, at the end of the year, I didn't have a single loan on my books.
Yeah.
So, it just sort of puts this thing in dimension here. We're sensitive to, even though we don't mark to market, we have a footnote. And at the end of the year, we had a loss on our portfolio. So this creates other kinds of risk, Jeff, in terms of how politicians might look at us over time. Even though we did an awful lot of good, and I believe we saved the system. We did what we were supposed to do. Otherwise, we would have had one of the, if not the greatest depression in history, one of the greatest depressions in history. So these are the kind of offset risks that monetary policy has to deal with. But my personal difference was I didn't think we need to go into the QE3 part, the $85 billion a month, because there's plenty of liquidity out there in the system. And that liquidity is not being used. And yet we keep adding to it. Now, I'm very pleased that we're cutting it back at $10 billion a month. We've gone from 85 billion a month to 55. If nothing occurs, my personal sense is, and actually Chairman Yellen has mentioned this program should run its course by October or in October. And then we'll have to see what we do with the base rate. We'll still remain accommodative because we want to make sure the recovery is fully intact. There is a history of the Fed of overshooting in its own way, that is staying too loose for too long. And I think all of us need to be on guard to make sure that doesn't happen. But I'm happy that we've at least, I had a chairman named Herb Keller who founded Southwest Airlines, not only one of the great business geniuses of all time, but perhaps the largest consumer of wild turkey bourbon. And he used to say, you know, we can't go from wild turkey to cold turkey overnight. We'll get the tremor. So, you know, at least Richard tried to get them to start paring back, and I'm quite happy that we started paring back. I wish we hadn't imbibed so much, but that's a given. And now we're beginning to slow down the pace of accommodation in terms of our asset sales, which will mean our balance sheet won't grow as quickly, and we won't have as much sitting on the sidelines.
Now, you know, you're really talking about the Fed policy. But I know you're, at any given month, you're in very close contact with a wide range of people around the world. And as you said, the accommodative policy is all over the place. Do you think that this episode in history is going to affect the nature of central banking or the way central banks behave over time? Or put another way, have we crossed some kind of Rubicon? Even if this is managed well, with all this relatively unconventional policy, will central banks, in a sense, have they de facto acquired a new role, a new persona, if you were to look ahead a couple of decades?
Well, actually, I think they have, partly because they can actually get things done, even within the confined spaces that some have to exist. For example, the European Central Bank is a young institution that's beginning to feel its way. We have 100 years of history. The Japanese Central Bank has been around for quite a while. All of us have to deal with political constraints and so on, but I almost feel we've become too central, meaning we're the key decision makers. And part of that's the default on the other side. Monetary policy is necessary but not sufficient to make economies work. You have to have incentives. One of my arguments is that we have, again, provided abundant liquidity at very cheap prices, but those that take that money, put it to work, creating jobs, expanding economies, creating wealth and prosperity, whether it's here or elsewhere, but are hampered by fiscal authorities, that is the elected parliaments or diets or congresses, that aren't providing the right incentives to take that money and put it to work. It's especially noteworthy in our own country here in the United States. We have a Congress that for the first time in 6 or 5 years have actually agreed on a budget, but it's a very temporary budget. If you're a businesswoman or a businessman trying to figure out how you're going to plan your future for growth, you don't know what your tax rates are going to be. You're not sure of how federal spending patterns are going to change and whether it affects you directly or your customer base or the economy. And then, of course, there's a constant complaint about the growth of the Federal Register and regulation. And then you have new regulations that keep getting changed, like the Affordable Health Care Act. Well, any business operator makes decisions under conditions of uncertainty, but when it's total uncertainty, you go into a defensive crouch. And you won't use that cheap, abundant fuel to grow. Instead, you'll just try to manage your bottom line and basically contain your costs. It's what I call the growth muscle, and most managers that I speak to now just aren't used to growing their top line. Instead, they're managing to maximum efficiency, maximum productivity, maximum cost containment. Well, if you get into that mindset, it's pretty hard to grow an economy. So I think the central banks are what people look to now. We make decisions. In the case of the Fed, we have a meeting over the course of 2 days. We announce when we're done what we've done, and we then issue the minutes, which people can go through, the best single document you can read on the Fed 3 weeks later. And we get it done efficiently under great leadership. Chairman Yellen in this case, or Chairman Bernanke, or whoever it may be. Whereas we watch our diets and our parliaments and our congresses debate endlessly and can't get a darn thing done. So what worries me, Jeff, is we have become too central.
Okay.
And we in the United States are the central bank for the world. So what we do has consequences elsewhere. and we get criticized for quantitative easing by, for example, the Brazilian finance minister. We're going to have currency wars. And then when we start tapering back, he criticizes us for tapering back. I worry that kind of prominence, typically, particularly in the United States, when an institution becomes so dominant, so prominent, the political authorities will reach up and pull it down. And that is of great concern to me. And you can see it in the case of Abenomics in Japan right now. Since the third arrow of that process and structural change, which you and I worked on so hard over many years, still hasn't taken place. The Bank of Japan is a key actor. I had lunch with Governor Kuroda last Thursday in London. We did a sort of dog and pony show speech for the London School of Economics. He's been in office 12 months and he's testified 50 times before the Diet. Yeah. What are you going to do? What are you going to do? What do you do? You see this now in Europe as well with the European Central Bank. Mr. Draghi gets more attention almost than any head of state. So I worry about that. And monetary policy is necessary but not sufficient. And we have to have fiscal reorganization and incentives to use the money that we create, and that's just not occurring. And so there's more pressure put on us as we go through time. Yes, the role of central banks has changed. I think we're way too prominent.
Okay, here's something else to worry about. I want to talk about Dodd-Frank, but
right.
Not the whole thing because it's very complex. One of the central objectives of Dodd-Frank was to make sure that there would never ever be a taxpayer bailout of big institutions. There are a lot of people who are saying that Dodd-Frank missed the point so long as we have banks that are too big to fail, and basically no matter what the regulations say, those banks will be bailed out. Now you have been you and the Dallas Fed have been extremely articulate and I would say really passionate about bringing public attention to this issue. So I wonder if you could just take a few minutes and come to the heart of it in terms of your thinking about these very large banks which have become even bigger and more concentrated since the crisis. What do you worry about, and what do you think as a matter of public policy could actually be achieved?
Well, first, thank you for mentioning that. We're not alone. It's not just the Dallas Fed. Right. I mean, you, for example, look at the new senator from Massachusetts, Mrs. She has been exceptionally outspoken on this issue. By the way, the only contracts lawyer that I know of in the United States Senate has actually read the legislation and understands every single page of it. So it wasn't just a feature of Dodd-Frank. In its preamble, its purpose was to prevent too big to fail.
Right.
What has happened since? You just mentioned that. You have even greater concentration in lesser hands, and therefore the risk is higher. Operating under the directives and the dictates of Dodd-Frank, we at the central bank have been putting in place new scrutiny of these very large institutions. We just this week had the results of the so-called stress tests, which are testing the larger institutions that are systemically important to see how they're positioned from a liquidity and capital and other basis under an economy in duress like we had before. We've expanded our regulatory intrusion into these institutions. But your real question, and I think that's good, by the way, but there are also, I still think, risks are in the system. Part of it is structural. Ultimately, the definition of what is a systemically important financial institution in and of itself becomes almost a premium grade. The New York Fed just released some studies 2 days ago validating an argument we've been making, which is there's a cost of funds advantage. If you assume that you cannot fail or you're systemically important, you're going to be able to finance yourself a little more cheaply than others can. So it makes for an unlevel playing field with the regional and the other banks around the country that are not considered SIFIs or not considered too big to fail. You have the potential for, I want to be very careful here, but corrupting the system and that an enormous amount of money is spent on lobbying or trying to approach the regulators. Again, I believe, knowing the people that I do that are in charge of this at the Fed, that they're incorruptible, but there's got to be that temptation by the institutions because they want to protect themselves. And then there is the basic issue of size and scope. I came out of a background of a small bank called Brown Brothers Harriman and Company. It's a partnership bank. It was almost beaten into you from the moment you got there with a whip that you had to know your customer. There is I don't know what the number is, but there's a size and scale where you don't know your customer. You may not, for example, know that even your own employees are trading a very large portfolio in London and creating an enormous risk at, say, a $6 billion loss to your bank, without mentioning what bank I'm talking about. So the problem has not been solved. The way it is structured now under the Dodd-Frank, there have been some improvements. We certainly are acting on those dictates. We also have another process taking place, which is Basel III, which is an international standard in which we are adding our own dimension. We have a governance structure within the Federal Reserve where this is actually now paid enormous attention to under the direction of one of the governors. Presently, it's Daniel Tarullo, who's doing a very good job on that front. But I just worry that in the end, if push came to shove, given that the Secretary of the Treasury chairs the systemically important financial institution body, that if one of these institutions had made a mistake, and we're trying to scrutinize them so that they don't, but if they got themselves into a liquidity bind, that they'd be bailed out. And you'd end up with even further concentration. So our proposal is very simple. What we worry about, and what Elizabeth Warren and other people worry about, is taxpayer exposure. I have no problem with a large, complex financial holding company. It's a question of, do we ever, again, could we withstand going through the process we went through before where we put taxpayer money at risk to bail out the system? I don't think there's any political support for that, and we would Bush 41ism deep doo-doo if we went down that path. So our proposal at the Dallas Fed is very simple. You provide the taxpayer guarantees for the depositors in the commercial banking side of a complex bank holding company, and every other transaction would be at risk. And both parties, that is every counterparty to a transaction, would acknowledge as such with a document when that transaction was executed, and it would make clear there would never be a federal bailout or any bailout whatsoever should the transaction fail. Now, the pushback on that is, well, it's easy to write these things down, but what if they actually do fail? And Anna Schwartz, you may remember, one of the great economists who only recently passed away, working so close, obviously, with Milton Friedman, is she said if you don't allow failure, then you just create enormous risk in the system. Now that our system is healthy, has been restored, but we're beginning to see little signs of excess driven by this interest rate regime that we have constructed. Now that we're healthy, I think we need to put in place very simple rules. And when mistakes are made, when you're healthy, you'll be able to, deal with it much better than if the entire system's at risk. So I'm not happy with Dodd-Frank. It was very well intentioned. I know both men, the congressman and the senator, no longer in service, but their intentions were good. But they created an uber complex structure, which I think does not solve the problem, and indeed may lead to creating another problem further down the road. Clearly not their intention, but I think this all needs to be simplified.
Let me go now to something else where I think you have done more thinking, and also you've had more experience, hands-on experience and policy experience than anybody I know, and that really has to do with the relationships with Mexico. But I want to construe this a little more broadly and to the how we should think about NAFTA in the global economy, and where you see what could it be. I'm not talking so much about today, but a decade from now, if things went well, how do you see the NAFTA arena, both in terms of the financial interactions, and maybe even more broadly, just in terms of a continental economy?
Well, first, if I may, Jeff, I think the critics of NAFTA, particularly as to whether or not it's improved the livelihood of Mexicans, are missing a point. And that is that enormous structural change has taken place in Mexico. It's actually an manufacturing exporting powerhouse now. From a governance standpoint, they have a totally independent central bank. From a fiscal governance standpoint, their deficit as a percentage of GDP is about 2.5%. They actually don't have a budget limit rule that's formal, but they have maintained their fiscal house in great order. They've been issuing 100-year bonds. They just issued a 100-year sterling bond recently, and they did a 100-year dollar bond early on in the process when rates started to dip down. So that's prudent financial management. And I actually think on fiscal policy, macro fiscal policy, I'm not talking about the drug issue, and I'm not talking about other micro inefficiencies in the economy, their telecom system, their education system, all very important. But as a government, as a Senate and a Congress, they actually get things done, and I often point to them as an example of how poor we are on that front. Okay. So these are the side benefits that came out of all that, which started by President Salinas, who is much criticized, and he had his faults, carried through by President Zedillo. And it brings into North America what, of course, is a well-developed, steady economy, which is Canada, small, about the size of Texas altogether in terms of its output, with the mega giant of the United States, and then it broadens it to the south all the way down to the Yucatan Peninsula. Now, how might it look against that background several years from now? Well, as you know, we've had an enormous development in the United States, which is our burgeoning energy resources driven by new technology, 4D seismology, fracking as it's called, and new drilling techniques. Mexico, because of its structure under their oil monopoly, Pemex, and also because of general anti-competitive forces in the economy, is beginning to change. And I can see 10 years from now, particularly given the incredible talent that has been shown by their current president, and the fact that what was set up under NAFTA, by the way, but not much discussed, this anti-monopoly or what we call the Competition Commission, actually now has real teeth in it, breaking down several monopolies in Mexico and making it a very efficient economy, and particularly on the energy area where they are underproducing. I doubt the Rio Grande, as we call it, or the Rio Bravo, as they call it, separates what's underneath the soil. They probably have an enormous resource that can be exploited, but they need to attract foreign capital to do so, and we have the greatest technology in the world, not just in Texas, but in the United States to do that, and they want that capital. So I could see a very prosperous Mexico. I was in Australia visiting with Glenn Stevens, the governor of the central bank there, a couple of months ago, and he gave me a lecture about how Mexico was not an emerging economy, it was an emerged economy. So impressed was he by the changes that have taken place. NAFTA enabled this. It ultimately will result in greater forces of competition within Mexico. The Competition Commission, which has been given some teeth now, when we first set it up, and I used to go down for those meetings, it was corruptible and it was inefficient, it didn't work. They're actually taking on Carlos Slim and his monopoly of telecommunications. They're actually taking on the one family that controls the corn market and the tortilla market in all of Mexico. They're actually taking on the biggest baked products company, Bimbo Industrial. By the way, these are all good people. I know all these individuals myself, but there's sort of an anti-competitive atmosphere in key product areas. And very, very importantly, they're changing the way that energy, which is considered part of the patrimony of Mexico and almost inviolable, will now be open to try to exploit it and figure out how to use the tax resources and so on to further advance Mexican society. I think it's well worth watching. There are some problems, by the way, and this has not been discussed publicly, but for example, it's considered a high-risk jurisdiction from the standpoint of our Justice Department and the way that they oversee the U.S. banks who might do business with Mexican banks because of the drug laundering money and so on. So, Jeff, consider this. Right now, most American banks are withdrawing their correspondent banking relationships with these Mexican institutions. Well, we want our energy expertise, say from Houston, the technology center of the world for energy, to be able to get part of that Mexican market. And we want American companies to be able to explore and profit from the new Mexican energy resources as they're made available. But if you can't arrange the financing through a correspondent bank for, say, someone delivers pipe or transports product by a vehicle, you're not going to be able to develop those resources. So here we are wanting a more prosperous Mexico. It's the soft underbelly of the United States in terms of any political instability, which I do not foresee. But when you think about it, it's the poorest of the three NAFTA partners. We want them to be successful. Our own laws, which are important, are preventing our own bankers from helping them actually get something done down there, which we all applaud. So it's a complex thing. It's constantly evolving, and it's a great question 10 years from now, if it's to work properly. It brings us all together. We'll be even more energy rich than we are. We'll bring business back from China, automobile parts, other manufacturing. You're seeing it already. It may not come to the United States, but it's coming into our neighborhood much closer. And we all will be the beneficiary of that as long as we let this thing carry forward. I think NAFTA over the long term is really something that both President Bush 41 and President Clinton, who implemented it, should be very proud of. It's one of the great developments in trade, and it's one of the great developments in our area of the world.
So a final question. You know, I knew this anyway, but just in the short time we've been talking, you mentioned all the people you've talked to in different parts of the world, and I know that has been your style for decades, dare I say. If you had to identify three concerns, long-term concerns, I'm talking a decade from now, three problems that the financial system is likely to be called on to deal with. And let's leave aside whether it will be equipped or not. Let's just talk about the challenge. I realize tomorrow you might come up with three more, but just sort of what would be three, not the only three, but what would be three really big fundamental challenges that will call on an efficient and stable finance system to deal with?
Well, this will seem like an odd answer to you, but I think making democracy work. Okay. Again, when you think about what, here we are, central banks just pouring, we're stepping on the gas pedal, we have the pedal to the floor. And yet someone's yanking on the brake, and those are the fiscal authorities. The fiscal authorities are elected by the people of democratic countries, whether it's in a diet or a parliament or a Congress like in the United States or in Mexico. So I think ultimately the fiscal authorities are going to have to figure out the right incentives in a cyberized, globalized economy as to how to attract capital and put it to work in keeping their people prosperous by creating jobs. I haven't seen that re-gearing in the United States. One thing is I often say, Jeffrey, is we still almost have an old Cold War fiscal policy. We really haven't transitioned to the cyberized, globalized world that we're in. So I think this does clearly impact what happens with the enormous and abundant and cheap excess liquidity that's slushing around the system. Right now, I can see one of the big risks would be it goes to speculative purposes, and that always is to the advantage of the rich and the quick, and it doesn't end up in creating jobs, which is where the middle income groups prosper. In our own country, in the United States, we've seen a hollowing out of the two middle income quartiles in terms of job creation. In fact, the last 12 years for the United States as a whole, ex-Texas, We've seen job destruction. In Texas, we have seen all four income quartiles grow significantly in terms of compensation and job creation. Well, you take the muscle, which is the middle income quartiles. I don't like to use the word class because as an American democracy, we are a classless society. We should be. But you do have to worry about those that are in the middle income quartiles, the belly of the system and the muscle of the system, when they start getting hollowed out. So I think that is of concern to me. You don't want too much maldistribution of income. You don't want it directed towards speculation. That can be very destabilizing financially, but also destabilizing from a political standpoint. So I think the biggest challenge is for the fiscal authorities to get their act together. It's not easy. In the case of the European case, you've got 18 countries in a broader context of 27 plus. We have to deal with one government here, and we can't get it right. It's very hard for them to get it right across all those fiscal authorities. So a lot of experimentation is taking place here, and I hope it succeeds because, again, we won. We won the Cold War. Mr. Putin's recent efforts to the contrary, at least in one part of the world, we went from mutually assured destruction to mutually assured competition. That's a huge leap, great accomplishment. A lot of brave leaders made that possible. But we got to make it work for the people. And if we don't make it work for the people, we only make it work for speculators and the rich and the quick, as I like to say, then I think we'll just undermine the basis of the beauty of democracy. So that's my biggest concern long term, Jeff.
Okay, I think that's a very powerful concern, and it brings together lots of things, and really the role of the central banks, the role of fiscal authorities, and then the bigger question of what is it all for. So I think it's a wonderful place to end, much as I hate to do that. Richard, thank you very much. Really, really interesting discussion.